Welcome to the Deep Dive. We're here to cut through the noise and get straight to the stuff you need to know. Today, we're tackling accounting errors. Sounds maybe a little dry, I know, but honestly, understanding these is key to seeing what's really going on with the company's finances. We'll look at what they are, why they're such a big deal, and how companies actually fix them. Our goal, like always, is to boil down the info from our sources and give you the important takeaways, a shortcut to getting up to speed. Now, before we really dive in, just a quick heads up. This discussion draws heavily from material provided by Farhat lectures. All the concepts, the examples we'll talk about, they come from the great accounting resources over at farhatlectures.com. So if you're studying accounting, prepping for the CPA exam, or you're already a pro, you should definitely check out their website. Lots of extra practice, videos, support, really good stuff to back up what we covered today. And a big thank you to Professor Farhat for making this material available to us. Okay, so let's start at the beginning. What exactly is an accounting error? Like fundamentally.
Well, fundamentally, it's pretty simple. It's a mistake, an unintentional one, usually. It's something in the financial reporting process that just, well, went wrong. It wasn't meant to deceive. It just happened.
A mistake. Okay. But what kind of mistakes are we talking about? Are there, common types?
Yeah, absolutely. The sources point out a few key kinds. You've got your basic math errors, computational mistakes, a slip of the decimal point maybe, or misapplying the facts somehow, getting things mixed up. And here's one that might seem a bit odd. Switching from a non-GAAP method to a GAAP method is actually treated as correcting an error.
Wait, really? Moving to the correct standard is an error. Why is that?
Seems like it should just be an improvement. It seems counterintuitive, I know. But the logic is you should have been using GAAP all along. So not using it from the start was the mistake. The prior financial statements were based on an incorrect method, making them misleading. Fixing it is correcting that initial error. This also covers changes in estimates if they weren't made in good faith. Things like bad debt, warranty costs. Normally estimates change. But if you change an estimate just to, say, smooth out earnings or hide a problem, that's considered an error.
Ah, okay. That makes me think of that waste management example from the sources. They changed their depreciation estimate, but it wasn't in good faith, right? So that counted as an error they had to fix.
Exactly. That's a perfect example. It wasn't just updating an estimate, it was manipulation masked as an estimate change. Other common ones. Failing to book accruals or deferrals properly. Not recording expenses when incurred or revenue when earned. That messes up timing. And then there's a really big one, misclassifying expenses, especially capitalizing costs that should have been expensed right away.
Right, capitalizing expenses.
Yeah.
And our sources mentioned the huge example there, WorldCom. That was massive, wasn't it? They capitalized billions in regular operating costs as if they were long-term assets, just completely distorted their profits.
Billions, yeah. It artificially inflated their earnings massively. It was outright fraud. And treating those costs as assets instead of expenses was the core mechanism. And it led directly to their bankruptcy. Shows you just how critical that distinction between capitalizing and expensing is, and how damaging getting it wrong or deliberately misclassifying can be.
Okay, so we have these types of errors. Math mistakes, misapplication, bad faith estimates, accruals, classification. Are there certain areas in the financial statements where these tend to crop up more often?
Definitely. Our sources break it down into a few key areas. Expense recognition is a big one, just recording the wrong amount or, crucially, in the wrong period. Same goes for revenue recognition, booking revenue too soon, or recording revenue that's, let's say, questionable. Then misclassification, which we touched on. Short-term versus long-term, sure, but the capitalizing versus expensing issue is often the most significant one there. Equity accounts can be tricky too. Errors in calculating earnings per share, or issues with how restricted stock, options, warrants, that kind of stuff is handled. Allowances and contingencies are another hotspot. These rely heavily on estimates. Think bad debt reserves, inventory obsolescence, tax allowances, potential lawsuit losses. Getting those estimates wrong or not making them in good faith leads to errors. And long-lived assets, particularly with impairment testing, that's another area heavy on estimation. Inventory too, issues with costing methods, physical counts, calculating cost of goods sold, lots of places for things to go wrong. And the bottom line for all of these really is that if the error is material big enough to matter to someone reading the statements, it generally means the company has to restate those financials.
Restate. Okay, let's talk about that. Once an error is found and it's material, how does that fixing process work? You mentioned retrospective handling earlier. What does that actually mean in practice?
Right, retrospective. It means exactly what it sounds like. You go back and fix the error as if it never happened in the first place.
Yeah.
You have to do this because the prior financial statements are now known to be misleading. You can't just leave incorrect information out there.
So you're essentially rewriting history in a way.
In a way, yes. Especially for comparability. If you show, say, 3 years of data side by side, investors need to trust that those numbers are calculated on the same correct basis. If year 1 had an error, you fix year 1 so it's comparable to years 2 and 3. All material errors must be corrected this way. Let's walk through how it works based on the sources. Imagine you're in year 20x5 and you find an error made in 20x4. If you're presenting 20x4 and 20x5 comparatively, you fix the 20x4 numbers and then present the corrected 20x4 alongside 20x5. Both years reflect the fix.
Okay, that makes sense for adjacent years. What if the error goes further back?
Good question. Say the error happened in both 20x3 and 20x4, and you're in 20x5 presenting all 3 years. You need to correct and restate 20x3, 20x4, and 20x5 to maintain that comparability across the board. Now, what if the error is even older? Say it happened back in 20x1 and 20x2, but you're only showing 20x3, 20x4, and 20x5 in your current report.
Yeah, how does that work? You don't show 20x1 and 20x2 anymore.
Right, so you can't directly restate those years in the current presentation. Instead, you figure the total impact of the errors from 20x1 and 20x2. You take that cumulative effect and adjust the beginning retained earnings balance of the earliest year you're presenting, in this case, 20x3. You basically dump the correction into the starting equity of 20x3. Then you restate 20x3, 20x4, and 20x5, incorporating that adjustment and any effects in those years.
Ah, okay, so the effect of the really old errors gets rolled into the starting point of the periods you were showing?
Exactly. And if you're only presenting a single year, say just 20x5, and the error was way back in 20x1, same principle. Calculate the total impact of the 20x1 error and record it as a prior period adjustment directly to the beginning retained earnings of 20x5. You're correcting the starting balance sheet equity for the year you're presenting.
That's clearer. It sounds complex but logical. Maybe a concrete example would help cement this. The sources had that Adam Company depreciation error. Could we walk through the numbers on that one?
Sure, the Adam Company example is great for seeing this in action.
Mhm.
So the situation was, in 20x1, they realized they forgot to record $10,000 of depreciation expense on a building back in 20XX. Now, here's a key detail. They did take the depreciation on their tax return correctly, so their tax payments were right. The error was purely on their financial statements, their GAAP books. And let's say their tax rate was 20%.
Okay, so they missed a $10,000 expense on the books, but taxes were handled okay. What did that do to their 20X income statement as reported?
All right, let's compare with error versus without error for 2000X. With the error, let's say income before depreciation was $100,000. They recorded zero depreciation. So income before tax was $100,000. Tax expense at 20% would be $20,000. Net income reported, $80,000. Without the error, what should have happened? Income before depreciation, $100,000. Minus the $10,000 depreciation gives $90,000 income before tax. Tax expense at 20% would be $18,000. That income should have been $72,000.
Okay, so the reported net income was $80,000, but it should have been $72,000. It was overstated by $8,000.
Exactly. Overstated by $8,000. Now, why not the full $10,000 of the missed expense? Because the tax effect. Since they didn't take the $10,000 expense for book purposes, their book income was higher, leading to a higher book tax expense, $20K versus $18K. That extra $2,000 of book tax expense offsets part of the missing depreciation expense. It often shows up as a deferred tax liability mismatch.
Right, the tax impact. So the bottom line net income was off by $8,000. How does this look in terms of the actual journal entries they made versus what they should have made?
Good question. What Adam actually did, because they handled taxes correctly but missed the book depreciation, likely involved an entry like this for taxes. Debit income tax expense, $20,000. Credit income taxes payable, $18,000, the actual cash tax, and credit deferred tax liability, $2,000. That DTL arose because of the big tax difference caused by the missed depreciation. What they should have done for 2000X was 2 entries. First, debit depreciation expense, $10,000. Credit accumulated depreciation, $10,000. Second, for taxes, debit income tax expense, $18,000. Credit income taxes payable, $18,000. No DTL needed if depreciation matched for book and tax or was handled consistently.
Okay, I see the difference in the entries now. So summing up the impact of the error on the 20X statements.
On the income statement, depreciation expense was understated by $10,000. Net income was overstated by $8,000. So the building's book value was too high, and that deferred tax liability account was overstated by $2,000. It shouldn't have existed due to this specific item.
Got it. Now for the crucial part, how did they fix this in 20X1 with a journal entry?
Right, the correcting entry in 20X1. You need to fix all those balance sheet accounts that were wrong at the end of 20X1. First, we need to get the accumulated depreciation right. So credit accumulated depreciation, $10,000. Second, we need to correct the fact that prior year's income and therefore retained earnings was overstated by $8,000. Since we can't change 20XD's net income now, the adjustment goes to retained earnings. So debit retained earnings, $8,000. Third, we need to get rid of that incorrect deferred tax liability. So debit deferred tax liability, $2,000, and that entry balances. Debit retained earnings, $8, debit DTL, $2, credit accumulated depreciation, $10. It fixes the lingering balance sheet impact.
Okay, so that entry cleans it up. How would that show up on, say, the statement of retained earnings for 20X1, assuming they only present 20X1?
Good point. In the 20X1 statement of retained earnings, you'd start with the beginning retained earnings as previously reported. Let's say it was $400,000. Then right below that, you'd show less. Prior period adjustment for depreciation error, net of tax, for $8,000. This gives you an adjusted beginning retained earnings of $392,000. Then you'd add the current year's 20X1 net income, say $220,000, and subtract any dividends to get your ending retained earnings. So that $8,000 correction for the 20X error directly reduces the starting point of 20X1's equity. It's dumped right there, as we discussed.
Wow, okay. That example really clarifies how it flows through.
Wow.
Even a seemingly simple error like forgetting one entry has these knock-on effects with taxes and retained earnings. It definitely highlights why getting the accounting right is so crucial for clear financial reporting.
Absolutely. It's not just about getting the numbers technically correct. These errors, intentional or not, can seriously distort the picture of a company's performance and financial position. This whole deep dive really shows that errors aren't abstract. They represent decisions, processes, sometimes breakdowns, and they can hide the true health of a business. So maybe a final thought for you, the listener. When you're looking at financial statements now, especially if you see restatements or large adjustments to retained earnings, what deeper questions might you ask? How can you try to ensure you're really seeing the full, accurate picture beneath the surface?
That's a great question to ponder, and definitely something to keep in mind. Well, that's all the time we have for this deep dive on accounting errors. Hope you found it useful. Keep exploring the topics that grab your interest. Until next time.